In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon, Market Rebels, and to everyone out there in YouTube land. And Stu,
Yeah.
we have a very cool, they're all cool topics, but this is especially cool and especially relevant. And you're going to find out, you're going to know immediately where it came from because we get this a lot, especially lately for some reason, in our Lunch Crunch Q&A. And it's a super common mistake, is all I can tell you. We see it all the time. I'd venture to say that 95, maybe more percent of all of the YouTube videos that you see out there, people like to teach this stuff, and it can really make you make some bad decisions. So we want to make
This
sure
isn't the topic of push button, get money, is it?
kind of related, but no,
Oh,
different.
okay.
They're
All right.
all kind of related about that, right? Because that's what most people teach.
I'm still looking for my button on my computer here.
Me too. Okay, so here's our question.
Yeah.
We're going to start off with our thought-provoking chalk talk question. Here it is. If you leg into a vertical spread, which means at a later time, right? So let's say we buy a call, and at a later time we sell a higher strike call, same month. That's what we call legging into it. We've completed the spread, but at different times. But however, we do this for a net zero. And what that means is that the price that we sold the second option for matches our first. So it's like we got all of our money out. And the question is, do you have a free trade? Are you sitting on a free vertical spread?
It's Bill. Anybody out there? Do you think anybody out there has ever heard the term? You don't get anything really for free.
That's where this is going. I knew you
So
would pick.
everyone, kind of, before we go into this, I know where this is going.
Yeah, right
Think
off the
about
bat, that
this.
should be a clue.
As Bill and I are speaking, mostly Bill, about this, think about the idea that if something has value,
Right.
then there's a pretty good chance nobody's giving it away for free.
Correct.
And your job as traders is to find the value.
That's right.
Where exactly is the value?
Yep.
Sometimes it can be a little difficult to find. And I'm kind of thinking that's where we're going with this, right, Bill?
That is where we're heading. Absolutely true. So let's go find out more what this is all about. So our question for today is, what's the opportunity cost? Kind of what you
There you
alluded
go.
to there. There you go.
There you
So
go.
in economics, they call these things opportunity costs when it's not what's called an explicit cost. You didn't actually physically pay money for it, but it's something that you still had to give up. So even this YouTube video right here, you might say, well, I didn't pay anything for it. It's just being aired for free. Well, that's true. You didn't pay for it, but you still had to sit and watch it.
Yeah,
And
to time. Yeah.
it's at a minimum, it's going to be time. If there was something else, and there's always something else we could be doing. And let's say if it were maybe working hours overtime at your job, well, you can't do both. That's a real physical cost, but maybe it would just be relaxing at the beach. You might say, well, that still has a value to you and you had to give that up. So that's what we talk about opportunity costs. And this is why traders make so many bad decisions because as you're going to see, these are very easy to overlook. So let's find out more about this. As always, quick little plug here. Not going to spend too much time on it, but right there on your screen, marketrebellion.com/. Get started. Over 40 courses, videos, all kinds of things on topics just like this to help you make better decisions. So let's look at an example here. We're going to do a couple of them, Stu, but the first one is a long $100 call. So let's say that you buy a $100 call, you spend $5 for it. Okay, nothing too earth shattering right there. We know
Okay.
that you have unlimited gains and we have a maximum loss of 5, the amount that we spent. So our risk curve expiration graph looks like this. We have a bend at our strike. We have unlimited gains. That's provided we get above our break even here at 105. And then what's our
Mhm.
maximum loss right here where we're lined up
Five
over there?
bones. That's what you paid for it. Yep.
5 bones. That's it. So that's the expiration risk graph. We have limited downside. It's called an asymmetric payoff, one of the benefits of options and one of the reasons
Well,
you have to pay an extrinsic value for them. It's a
oh
nice,
God,
it's an
I
insurance
hate
policy.
that theta, Bill. I hate that theta. I have to pay for that. I
Got
have
to
to
pay
pay
for that.
for this
But
asymmetric payoff to have unlimited gains to the upside. What do you mean,
it's
man?
a
It's not fair.
it's a huge benefit. You've got to pay for that. And that's why, yeah, you kind of touched on it. It's not really fair to say, oh, I got to fear theta. You're getting something for it.
Yeah, there's a
So
benefit.
what we're going to find out though is when we leg into a spread, there's a very easy opportunity cost that's missed. So promise this will be our last plug here. Marketrebellion.com/get started. Over 40 courses right there. Count them, Stu. Pretty cool ones, I have to say. Lots of things for free that will help you to make better decisions. So here we are. We started off with our long 100 call, and
Mhm.
now we're going to short a 105 call.
This is
Same
after
expiration.
the 100 call performs. It went up, and
Yep,
now we're gonna, because remember when you bought the 100 call for 5, the 105 call was not trading for 5. It was trading for something lower than 5, 2 maybe, or 2.5, or something. So
correct.
so now the stock lifted, and now the 105 call, which used to be something lower, is now higher. It's now 5. We just kind of picked that because I guess Bill picked it because that's the price he paid for the 100. So now they are both what was 5 on the hundreds, which is now higher, hint, hint, and now the 105s is now 5. So we're going to go ahead, Bill saying, go ahead and sell that at 5 to have a net cost, dare I say, cost basis of the spread of 0.
Right. So now what we're going to do is I'm trying to set up my pricing model right here real quick. I don't know why that got shut down. So again, we started off with this $100 call for 5. That was our starting
Yep.
point. And
Yep.
at a later time, that's important. Obviously, this could not have been done at the same moment. That would be
Right.
almost an arb, too good to be true. But some time had to pass and the stock had to move in our favor.
Yeah. Even
Because
if
we
it's
know
that
if the
same day or 10 minutes later, the stock
it
moved.
could be correct. So we know that if the $100 call, again, these are the same expiration we're assuming, is worth 5 when we bought it, the 105 call could not have also been worth 5. It had to be worth less. So
Mhm.
this tells you that it had to be at a later time.
Yes.
So now the question is, this is what most traders do. They'll say, well, gee, Stu, I paid 5
Mhm.
and I collected 5, so I've gotten my money back.
Yep.
But I still now I look in my account, I still have this vertical spread sitting here that might make another 5. And the question is that really what's happening? Do you have a free trade? So this is what people think that we started off with our risk graph down here, maximum loss of 5, unlimited gains. And once we sold this spread, we have switched or morphed from this black line into this vertical spread. That's what people think. They say, okay, I've got the bend at 100. I can now lose 0. I've got another bend at 105. I might make another $5. But right now, I've gotten all my money back. What could be better? and they jump on this opportunity. And what we're trying to show you is you got to hit the brakes because this is not what you have. Now, why is that? It certainly seems like it, doesn't it? I paid five, I collected five. So what's missing here?
Well,
Well, let's go to a pricing model and take a look. So here we've got the stock at 100, the strike at 100. We have 60 days to expiration, interest rates and dividends zero. And I chose this kind of odd sounding volatility number of 31 because that's what gives us a $5 call price. And that's what we assumed in the presentation. But now we could do all kinds of combinations. Let's say that some time goes by, 5 days goes by, so we have 55 days on the clock. But let's say that the stock maybe goes to, let's try 105 and see how that fits. And I'm sorry, let's go to 105 strike.
so stock lifted, and we're looking at the next strike up.
Now we're looking at the 105 strike and we go, hey, look at this.
Whoa, that's
It's
trading for 5.
it's I can get all my money back.
Yep.
Got to do it. Let's go sell this call. I've got this free vertical spread.
Yeah.
Risk aversion sets in. I don't want to have any risk. What could be better?
Yeah. Happened
Well,
today at AMD. It was up $20. Yeah, of course. Go ahead.
so what is missing here? Well, what's missing is if we go back to the 100 strike,
Yeah, what was
which is
that
what
trade
we're
at?
still holding. It was 5 when we bought it.
Now it's, see, the stock's 5 points higher, and now it's 8.
Now it's
So
8.
so what are you missing? Well, like, it's not hard to see what you're missing. It's $3.
It's $3.
Right there, that's what you're missing. You're missing that $3. You want the $3 now, or do you want to ride the spread and see what happens?
Correct. Because what you could do, this is what we tell people all the time, if you don't believe that it's worth $3, hit sell. We're going to round that to 8. You paid 5. It's now sitting there in your account for closed at 8, and there's $3.
Yeah,
And if you want, you can turn right around and buy it back for 8 and say, well, gee, now my cost basis is 8. Well, which is it? The cost basis, at least for trading terms and risk measurement, should be the current market price. Doesn't matter what you paid
mark
for
to
it.
market. Yeah, for sure.
Mark to market. So that's our opportunity cost. And the reason, again, that it's the opportunity cost is that we had the choice to sell it. We chose not to. Just like you had the choice to maybe
Yeah.
relax at the beach. You chose not to. You chose to watch Coach's Corner. There was something you had to give up. And what you gave up by saying, you know what? Hold on, Stu. I don't want to sell this 100 call. I want to leg into the 100, 105 vertical. But we
It's a
see it
choice.
as like, yeah, we think, well, I've only got $5 into it and now I've got my money out. So the way that we should see this is that we have $8 of a cost. Now, this isn't for tax purposes or accounting purposes. It's for trading decision purposes. We need to see that we are using a call worth 8. Why? Because it's worth
8.
8. That's why we're valuing it at 8.
Can't deny it. That's where it's trading at.
That's where it's trading. So instead of thinking that this is your risk graph that you've legged into for free, if we see it as a cost of 8, an opportunity cost of 8, even though we didn't spend it, it's not an explicit cost, it's an implicit cost. We're going to use that instead for our long position. We should really see that we have done this. We've now legged into a spread where we could lose 3 and we can make 2.
See, that's that $3 that we were talking about.
That's
the
very
5 to the 8. That's where that $3 is coming.
That's very different from saying that you had a free trade.
Yeah. That's an opportunity that you said, no, I don't want to do it.
I don't want to do it. And you could have, you pass it up. But because people just say, oh, I paid 5, I can get 5, and now I've got this free asset, it's a good move.
House money, blah, blah, blah.
Yep. Now, here's another way that I like to look at it. If you don't think that it's the market cost is what matters, if you wanted to buy that vertical spread right now, what would it cost, Stu?
Well, I can tell you it's not going to be 0.
Right.
Right?
What's
It's going to be 8 and minus
minus
5,
5,
which is 3.
So if the market is valuing this spread at 3, why do we have the right to value it at 0?
Yeah, exactly. That's a great way to put it. That's a great way to put
It's
it.
just not, the market values it at 3. It
Yeah.
must be worth 3.
3. Yeah.
Right. Don't sit there and say it's worth zero. And that's what gets traders into trouble because they're not accounting for the opportunity costs
Because
at
they're
all.
leaning on, oh well, I bought it before, and now this is what it is. So,
This is
but
right.
now it's going to cost me
Your
zero. No,
cost doesn't matter for those decisions. It's a
that
sunk
thing is
cost.
8 right now, all day long. You could buy it and sell it all day long,
That's right.
everything being equal at 8. Period.
That's right. Yeah. So you have to say. In fact, I was doing a an article for our option school, and I threw in a little kind of a little thought question for people saying, why is it that you read these stories sometimes, these very troubling stories of a guy who bought, let's say, 100 Bitcoin back when it was trading for $1, and he
Mhm.
owns 100 coins that's worth 12 million now, and he goes out and he gets drunk one night, he ends up hauling it out to the trash, and now it's sitting in a landfill and it's gone. Well, why do people find those stories so distressing if he's only got 100 bucks into it? See that, and people go, well, oh, it's distressing because it was worth 12 million. But
Yeah,
then
it's
when
that
they're trading, they
opportunity
say,
cost.
oh, no, no, it's worth 5. No, it's
Yeah.
not. It's worth 8. So keep that in mind. All right. So now we also know that some people are still going to say, I don't know. This sounds like a counting sleight of hand here. If I paid 5, that's the way I want to see it. I've got 5 into it, and that's the way it is. Well, hold on. Let's do a different example. Same idea, but a little different. One of my favorite techniques is to go to extremes. It's a wonderful technique to help you kind of shine a spotlight on what really the issue is. And so we've done this many times in Lunch Crunch, where we'll say, well, instead of thinking that the interest rates are 2% or 3% very low, where it's hard to see the effect, make them 20%. And some traders say, oh, but that's completely unrealistic. That's not the point. The point is it allows you to see where the things that we're looking at are, where the problems might lie, where the opportunities might lie. So let's do that here, Stu. Let's go back to our long call. I put that in there just for you. One of your favorite expressions. Everybody Stu loves that one. Buy $100 call for 5, and the stock rises to now 120 bucks.
Mhm.
The $100 call is worth 20. It's at parity, no extrinsic value. And we look and we say, holy smokes, hold on, Stu. Look at this 105 call trading for 15. Instead, I could sell that for a $15 credit. I've got more than covered my expense here of 5,
Mhm.
and I still have a free vertical spread.
Mhm.
How do you like them apples? How can you deny that that's not a cool trade? Well, again, do you have a free vertical spread? So if you thought you did in the first case, watch this one. This is what people think they have, but if we account for the opportunity costs, this is what you have.
And
Hold
there's
on
that
a
5.
second. You're telling me I can't make anything and I might lose everything? How is that possible? That's exactly what we're telling you. Because let's say that remember you're short the 105 call. Let's say the stock is down here, falls to 105. Now, for everybody out there that's watching this, what's your $100 call worth?
At that
Remember,
moment.
you
At
sold this 105, you got $15 cash, no argument. What's that $100 call worth? It is worth $5. All right, so you're going,
this
hey,
is when the stock goes back to 105.
105, we're at expiration. So you're going, okay, now I can pocket another 5. I can close this for 5. And that 105 call that I sold for 15 that was also an obligation, I owe nothing from it. So I also capitalized on that 15 bucks. So I have a $20 gain.
Mhm.
But hold on a second. What did you have before you even legged into the spread? A $20 gain. See, this is a really beautiful way to show that it was not free. All you did is you put yourself into a situation that the very best you can do is where you were, but you're taking a risk. You had the $20 for sure, right? The stock's at 120, you've got the 100 call. We could have taken that for sure. We said, no, let's leg into a spread. Now I might have 20, but what else could happen? Total washout. This is what we call a danger, right? In finance, it's a term we sometimes use that means there's really, in this case, certainly no benefit, but a lot of risk. And yet we painted it as a picture that you spent five, you just got this big $15 fat credit, and you have this free vertical spread. And that's not at all what happened. But that's easy to step into if you're just looking at these debits and credits without looking at the opportunity cost. So the main thing to probably get from this is whenever you're trying to value a position or a move, whether to sell it or to leg into a spread, what's the opportunity cost? Current market value. Because in this case, you could have sold your call. First example, could have sold it for 8. Here you could have sold it for 20. You have to account for that. See, so in this case, if we valued our call at 20 and we sold that one for 15, how much do we have into the spread? 5. What's the most it can be worth? 5. We can't go anywhere. We just can't make anything. And then that really shows you it's just a bad idea. And there's a lot of people who will tell you, absolutely, it's a free trade. So we hope that gives people some things to think about. It's a topic we've been kind of talking about loosely in Lunch Crunch, and we'll certainly touch on it more this week. But we hope that at least gives you things to think about in the meantime.
Yeah.
So
Always just think about like what can you do now?
what can you do now?
But where's the opportunity that you could take now?
Yep,
Stop thinking about like, oh, maybe it's free because I paid 5 and now I can sell them for 5. Think about where the first one is actually trading and what you can gain from those dollars, those additional dollars or profit, if you want to call them profit, versus trying
that's
to
right.
hedge off and having what you think is a free trade. That
A free trade.
opportunity cost kind of makes it not a free trade.
That's exactly right. And we're not saying it's a bad idea to leg into a vertical spread, or we're not saying that you have to take the quick profits just because it's an opportunity cost. We're not saying that at all. We're saying just make sure you understand the trade-offs that you're facing when you make a choice, whether to close that call, leg into a spread, or whatever. But you need to understand it's the current market value that's your opportunity cost. So, what do you think, Stu? If you leg into a vertical spread for a net zero, do you have a free trade?
Negative.
You're saying negative? That's what I came up with too. Not even close.
I mean,
All
I
right. So
would look at it as a free trade. Somebody might, but there's always that opportunity. You always have to look at the
you have
opportunity.
to you have to consider the opportunity cost, right? And again, if you still find that hard to believe, think of my Bitcoin example. If you had 100 coins, you paid $100 for 100 Bitcoins. It's worth 12 million. You sell a few to get $100 back. You go, oh, at least I got all my money back. And then you lose the hard drive and you can't find it. Are you going to say, ah, it's all right, I got all my money back?
I
I
wouldn't.
broke even. I
I mean,
doubt very few people would
I
see
deal
it
with
that way.
it. And
Yeah.
on that example, everyone, kind of just think about this, like real quickly for just make it super easy. You did whatever you did. You bought them at 5, stock went up. You sold them at 5. It's free. Blah blah blah. And now the stock tumbles. Now at the end of the day, it's trading at 90. It's over. It's expiration. Now it's 90. So both of them are zero.
Both are
Right?
zero.
Hundreds are zero. The 105s are zero. Everything's zero. You got zero. You got zero into it, and you made zero, and you didn't lose any money. But what could you have had you taken another approach? And that's the opportunity cost that Bill's
It was
talking
three.
about.
That was
But you,
$3.
you know, you have to somewhere in the discussion, you have to consider that.
That's right. That's all we're saying. We're not saying that one's right or wrong. We're saying don't look at this and say it's a free trade when it was really a $3 opportunity cost. And if you do that, you're going to make much better decisions. And if you're making better decisions, that can only lead to better results. And that's what we want to do
Mhm.
here at Market Rebellion. So we will see most of you or many of you on our lunch crunch for tomorrow. And the rest of you, we will see you next Thursday on Coach's Corner, and we'll see you then.